right, so you got an exam on Tuesday. Question 1, you're going to submit on Blackboard. It's due by 2:30 on Tuesday. I've already set it up, so it's there, so you can plug it in there. The biggest way to lose a lot of points on question 1 is too much copy and paste and plagiarism, so it needs to be all in your own words. And in question 2, we'll do in class for the first 30 minutes of class. You'll handwrite it. We'll still have class afterwards, so I'll check attendance after the question. So I don't want to lose all that class time. So question 1 is open book, but you got to put it into your own words. And in question 2, we'll see. This first exam is so eye-opening to me. I can tell the semester, you can probably tell, there's students that are incredibly engaged this semester, and there's students that are just completely, they've already left. They're like already on winter break. Boy, I can tell the difference, and I think it's going to show up in this first exam, and it's going to come up in the instructor survey. I have students every semester. This instructor is just too hard. He expects too much out of us, and I think we expect way too little out of you. But that's the argument. This stuff is way too hard for us. And what do you think I want to do with that? I want to show them the papers of students that got hundreds and 98s and say, well, it wasn't too hard for them. So what's the difference? Why do some students make 98s and some make 2%? So because you're too hard, professor. Does that argument somewhat break down? All right. And they say, well, the 98 percentiles, they're spending like 40 hours a week on your classes. Yeah, I'm pretty sure they're not. So I don't know, you know, my goal is to make you as successful as possible, and you're going to be successful because you know stuff, not because you make A's on multiple choice questions. It's because you actually know stuff. Someone asks you a question, you can answer it, right? Someone says, hey, I've got $500,000. I want to invest it. What should I do? Oh, well, give me A, B, C, D, E choices, and I'll tell you. No, that's not the way the world works. So we'll see. We're going to see who's engaged. Tuesday was interesting. We had one entire team not even show up, so 6 people, and so that's kind of interesting. So I have students that do poorly, and I'll say, well, we talk all about that in the Tuesday session. Oh, I didn't attend that. Oh, okay, well, that kind of explains it. But it is out there on Blackboard. Oh, I didn't watch it. Okay, what did you, then that's one thing. If someone might want to help me on this exam, I've always wanted to do this. If someone makes like a 6% on the exam, I'd love to sit down with that student and say, tell me exactly what you did to prepare for that exam. And what would they likely say? Tell me exactly what you did. And they probably prepared for it like they prepare for, you know, their multiple choice exams. That's not going to help you very much in this class, because there's no multiple choice here. So I'm really curious, how many hours did you put into it? You know, this is an exam, so it should, you know, 5 to 10 hours at least, I would say. But I don't know. It's like, no, I'm not taking college to spend time. I'm taking college to get a degree. It's like, well, okay. So yeah, you know, this is my soapbox. Why are we doing all of this? You know, it just seems like we're kind of missing something. But all right, let me get everybody real quick. Oliver, Carlos, Jonah, Tony, Hunter, Farah, Carlos, Anthony, Alex, no, Adrian. Yeah, I got you and Alex in the same seat for some reason. Olivia, Akash, Joshua, nope, Blake, Giselle, Brian, Luke, Colin, Alvaro, Eric, Tiana, Christopher. All right. And there's some people in this class I've not seen yet once. I remember one semester a student emailed me, Professor, I work during your class, so I won't be able to make any of your classes. Would that be a problem? It's like, where are we? Is this like, I don't know, is it Saturday Night Live? Am I like in a sketch here? Yeah, if you're on Zoom, you only get credit if you submit your notes. So that's the only way to get, that's the only way Zoom works. All right. I know y'all hate my soapboxes, but boy, I don't have to be here. You know, I'm independently wealthy. I'm here because I believe in this stuff. So, you know. All right. So real quickly, forward exam one, you've got the first question. There's the outline. There's a lot you can definitely flesh out on this question. So you've already got it. It's in the notes. It's essentially talking what we've done these first few weeks in your own words. I remember last semester I had a few papers where, boy, they were great the first 70% of the question. And then they started getting late and just kind of died out at the end. And they lost a lot of points at the end. They got to the equities and it was like there was just nothing there. So I'm not sure what happened there. I was thinking, wow, that's a great question, great answer. So, you know, pretty straightforward. You're not going to be able to write all that down because you already have all that. So, and then make sure it's in your own words. So anytime I see my words word for word, that's 0 credit. All right, I already know this stuff. I've been in the business for 30 years. All right, I don't know it as well as I should because no one does. But you know, you're not going to get a grade because you use my words. So you got to put it into your own words. You can try that in an interview. Well, I don't know that, but my professor does. Well, then, you know, we can hire your professor. It's like, well, no, I'm not working anymore. So you're going to have to be on your own. You're going to have to prove that you know this stuff. Make sure it's, you know, good jargon. We talked about the jargon throughout. It should stand on its own. Someone shouldn't have to, you know, if they're looking at it, they're like, wait, what is this all about? It should be, you know, pretty obvious what you're doing. Everything you ever write should always say, you know, someone sits down and read it and know exactly what you're doing. If you want to put extra stuff in there, that's always great. And then the tactical question, we went through that on Tuesday, so I won't do that here. But the tactical question, any questions on the tactical question? We got a good start on Tuesday with Luke's answer, although he did use 25% instead of 30%, and he knew the right answer on that. He just picked the wrong number. That was the only thing in his whole answer that was off, and that wouldn't have cost him all that much. So yeah, we had a really great start to that to the day. But the challenge he's going to have is he only has 30 minutes on Tuesday, right? So he's already said I'm going to have to cut it back some. But yeah, I mean, I'm glad some of y'all are already way ahead of the curve. All right, so y'all get the tactical side. The tactical side is to me where you prove really if you really understand this stuff or not. All right, so we'll see. I'm hoping the entire class aces this exam, but we'll see. That's never happened before. But maybe to be the first class that every student makes 100. Boy, that would be an exciting day. Which I know I could do that, right? How's the easiest way I could do that? So I could just give everybody 100, but what's the fun of that? That would save me 20 hours of grading, but does anybody do that? I had a student I was mentoring in high school. I was trying to get him in the UT Austin, and he kept making B's in his English class. And I go, how are you making B's in English? You're a really good writer. And he says, well, everybody gets a B. And I didn't believe him. I thought so one day I come pick him up and his teacher says, well, you can't leave until he turns in his paper. So he turns in his paper. She writes a B on it. She writes a B in the grade sheet, hands it back to him, doesn't read a single word. I was kind. Gotta be kidding me. So that does exist, but that's not me. I'm not that kind of professor. But boy, think of all the time you could save if that is your teaching approach. All right. So they were going to keep going on execution. So we already talked about that. So yeah, so last week we talked, our last class, yeah, it was last week, we talked about mutual funds. You know what a mutual fund is? You buy mutual funds from mutual fund companies like Vanguard, Fidelity, T. Rowe Price, those type of firms. Most of those firms also offer these other products we're going to talk about, but that's the most common approach. I ran mutual funds at UTSA. I don't like mutual funds. The main thing I dislike about mutual funds is they're regulated to the extent you can't do obvious things that make a lot of sense. I mean, a good example, in 2008, we had the big blow up, and Matt ran USA's high yield bond fund or high income bond fund. It was called high yield, but he discovered in 2008 he could buy investment grade bonds with the same yield as high yield that were much safer. So essentially he could buy much better bonds for the portfolio, really good return, but much less risk. And he couldn't do that the SEC said he couldn't do that because his bond was named high yield. Because it was named high yield, he could only buy high yield. So what did they have to do? They had to spend several $100,000 to change the name of the fund to high income instead of high yield. And that's pretty stupid, isn't it? But he couldn't do any. So they're very, very regulated. They got these prospectuses. And every year we have a question, how do you want to change prospectus? Because it's so expensive. You got to change the prospectus, which is a big publishing thing. Then all the mutual fund investors have to vote, make that change. You know, so it's just a major, major undertaking. And I never liked that restriction. So what else is there? Well, you have commingled accounts or separate accounts. A separate account is you're a big investor. You go to Vanguard and you say, hey, I've got 400 million bucks. I want you to manage it for me, but it's just, I want my money all by itself. I want you to manage that bucket of money. Do the exact same thing you do over here, but it's just my money. That would be a separate account. A commingled account is when you say, hey, I've got 50 million bucks. I don't want to be in a mutual fund. Put me into a really nice institutional fund with some other big investors, and we'll do that. All right. So these look a lot like mutual funds as far as the daily pricing. You know what your return is all the time, but they're not traded on public markets. It's only between you and a big investor. So you can, you know, set up your own rules. If you do a separate account, you can set up your own policy and however you want to manage. So usually for separate accounts, you're going to need, depends on the asset, you're probably going to need 100 million, 200 million types of dollars. These are big, big, big accounts. In fact, I remember at USAA, we had a few $1 billion with Barclays, and they came in and visited us, and I said, well, we must be one of your biggest accounts. And they said, oh no, you guys are, you know, that was a chance for him, you know, to butter us up, and, you know, but he didn't. He said, no, you guys are peanuts to us. We have a lot bigger accounts. I said, okay, thanks for visiting us. So these are huge. There are, you know, there's some teacher retirement funds, there's firemen retirement funds, you know, we're talking multi-billion dollars that they have with these firms. They tend to charge much less, and you don't have to worry about the cash flows of the other investors. You know, if you have a mutual fund, everybody wants their money out at once, it's going to mess up your account. But with the separate account, you have complete control, you have your hands on it, and there's no one else doing things. So here's the big one, right? This is what everybody's doing now. Exchange traded funds, ETFs. Are y'all familiar with these? How many of you are buying these things? Anybody in here have ETFs? I've been loading my mom's portfolio up on ETFs. So an ETF is essentially a mutual fund that trades like a stock. That's really what it is. So mutual funds, remember, you can only buy them once a day, right at close. Right at close, that's all you can do. One trade a day. With exchange traded funds, you can buy them just like any other stock throughout the day. They trade just like stocks. They have tickers, they have stock prices, and they, you know, you can watch them throughout the day. So they're much more liquid, much easier for you to trade. You can do intraday trades. You can better control the timing of tax gains and losses. Now, I used to believe this wasn't that big of a deal, but I read a really good paper that ETFs really do manage your taxes better depending on the asset class. You really can get much better ahead there. Why are they so popular? You know, who knows? I'm going to show you some examples of ETFs here just so you can get a sense of this market. It's a pretty bizarre market. I do like them. I do like exchange traded funds. More than mutual funds. They're not quite as difficult with the regulatory side to manage. We did not have ETFs when I was at USAA, but Lance at USAA, I'm trying to get Lance to come speak to the Investment Society again. He's a UTSA alum, and he started the ETFs at USAA, and now they're at Victory Capital. So he started those up, and he's doing what's called smart beta. Y'all know smart beta? Anybody here know smart beta? Smart beta sounds better than dumb beta, right? So, and if you really want to learn smart beta, go find Robert Arnott. He's the king of smart beta. Well, he's not the king. He's the godfather of smart beta. Excuse me. I don't know what the difference is. Why? He's a godfather all the way down. I'm not sure what's the advantage of being a godfather of something. You're going to adopt it, smart beta, if its parents pass away. I don't get that. But anyway, All right, so he's a godfather of smart beta. He's written several articles, and he's an incredibly excellent speaker and article writer. So if you're not familiar with Robert Arnott, go out on YouTube, type in his name, and watch every video he's ever been in. He is. I've been at a few conferences where he's spoken, and it's so hilarious. He finishes speaking, everybody's like sprinting to the lobby so they can make trades on their phone. He's pretty low key. I used to think he was kind of an arrogant guy, but he's not arrogant. He's just real quiet and shy. He's really a very, very down to earth and friendly guy. But he just talks, and it's kind of monotone, and everybody's just clinging on every word he says because he's such an interesting speaker. I met him once at UTSA. Got to talk to him. Told him, I was kind of overly complimenting him. I am a big fan of his. He was the editor of the Financial Analyst Journal, and when he was editor, that was the best that journal ever was. So I got to tell him that. I said, man, I wish you'd be editor again, because man, that journal was so good. But yeah, he's someone you should definitely get into your reading list, definitely get into your YouTube. So he's a smart beta. What is smart beta? We're going to talk about beta as a calculation, but beta here is talking about how you get an asset class like large cap growth or large cap value. That's what we think of as beta, as your market exposure. And what he says, there's a smarter way to get beta than buying an S&P 500 index fund. So you have to read about it. Now, not everybody agrees with him. And so then you can go read my other favorite writer, Cliff Asness. Cliff Asness does not believe in smart beta. So what does this say right here? Oh, why is it not showing on? Sorry guys, why don't y'all tell me earlier? Because man, I'm trying to. Y'all are wondering what I was saying about Godfather. So here, so there's Arnott, Godfather, smart beta, smart Godfather, Godfather. Why is it not up there? Okay. Thanks. I don't. Well, UTSA Tech. It's just not. Someone did this for me earlier in another class. Was it never up there? It's just from the PowerPoint. Yeah, I don't. Try. All right, I'll start over again. All right, so anyway, Cliff Asness, A-S-N-E-S-S. So I'll just read to it what you said. It says up here, I don't know how the Zoom is doing. It's on the Zoom out there. So see, Tiana thinks I'm talking normally here, but it's so it's calling Rob Arnott the godfather of smart beta. But then this first article that comes up with Cliff Asness says smart beta war rages on as Cliff Asness slams Arnott's paper. Now, do these two people hate each other? No, they highly respect each other. But it's an interesting little battle going on between the two of them. They're two of the best writers and speakers out there. Cliff Asness is frequently on podcasts, and you should listen to him anytime he does a podcast. Very, very smart people. In fact, if all you did the next 12 months was just listen to and read everything from Arnott and Asness, you would be in really good shape for interviews and jobs and that kind of thing. So what is smart beta? Well, when you buy the S&P 500 index fund, they just buy all the 500 stocks proportionally to their market cap. So if Apple's 5% of the market, you're going to be 5% in Apple. If the S&P is up 5%, what are you going to make? You can make 5%. All right. Smart beta says, well, market cap, that's not the smartest way to put money in. Smart beta says, okay, market cap is not the right answer. We need to find some other way to weight the indices. So have you ever heard of fundamental weighting? So fundamental weighting says, don't weight Apple based on market cap, weight it based on revenues or based on net income or book value. You find some accounting number that you're going to weight the stock on. All right. And what we discovered over time is that smart beta, when you use revenue or net income to weight instead of market cap, it outperforms market cap. So Robert Arnott says that's a smarter way to get your beta. Why would you just use market cap? Now, when the first index funds came out, they didn't use market weight, they used equal weight. So if you had 500 stocks, they put 1/500th in each stock. But they quickly discovered that was really difficult, because that means every single day their weights were all off, right? Every time a stock changed, you had to, and so it got really expensive. So they didn't create indexes based on market cap because it was the right answer. It's because it's the easiest to maintain. What's the nice thing about market cap? If Apple's price goes up, so they go from 5% of the market to 6% of the market, what do you have to do? Nothing, right? They're still exactly the right thing. So why would smart beta maybe outperform? And Cliff Asness says it only outperforms because when you do smart beta, you're ending up with value stocks instead of growth stocks. And why is that? What is a value stock? They're cheap stocks, which means what? When you use market cap, they're underweight. When you use fundamentals, they're overweight. And Cliff Asness says it's not smart beta, it's just value investing. All right, y'all see his argument? If you do smart beta, it's just value. And that's the thing Arnott understands all that. Arnott's a very smart man, he understands that. And so that's why their debate is so interesting. And when you hear Cliff Asness, I've heard him on a few podcasts, he talks about a time when he and Robert Arnott get together and how they joke with each other and make fun of each other, but they definitely highly respect each other. So so this is a great thing. If you're going to interview with Victory Capital, I would definitely make sure you understand smart beta, because that's their thing. They didn't create index ETFs, they created smart beta ETFs. I have no idea how they're doing, but okay, I don't even know if I'm still on Zoom or not. Am I sharing? I am sharing, so hopefully. So Tiana, let me know if this goes back. Did I go back to PowerPoint, Tiana? Okay. All right, sorry guys. Okay, so that's an exchange traded fund. We'll get into a little bit more here because they've gotten pretty radical here with exchange traded funds. It used to be when they first started out, they were almost all index funds. So large cap value, large cap growth, small cap, the developed markets, emerging markets, just index funds. But now they broaden out to a lot more active management. Smart beta kind of came in next, and then actual active management. So essentially they're just replacing, and they're much more popular than mutual funds. If you look at cash flows over time, mutual fund cash flows have been steadily coming down quite dramatically, and ETFs have been going dramatically up over time. And who are the big ETF providers? Well, the same as the big index providers. So BlackRock, State Street, Vanguard. Vanguard has their own series. So what is State Street's called? They show an insect pressing Reutz. Does that help you at all? Have y'all seen their commercials? They have this insect. I have a spider pressing. So they're spiders. Have you heard of spiders? SPY, which is the S&P 500. So the spiders. So their advertisement is a spider pumping iron. What are BlackRock's called? They used to be owned by Barclays, but now they're Black. That's one of the reasons BlackRock is the biggest, almost $10 trillion, the biggest investment firm. They bought all of Barclays. So iShares, have y'all heard of iShares? Does that sound familiar? What are Vanguard's called? So Vanguard named them something that would eat a spider. So theirs are called Vipers. So there's this interesting. Vanguard did something really interesting. When you create an exchange traded fund, at first you have to fund it with cash and get it started. And that's the way most of these do. So you start a new ETF, you usually have to fund it somehow. You have to find some parent company to put 50 million in or something to get it started. But Vanguard said, no, we're not going to do that. When you buy Vanguard Viper, you're not in this actual portfolio. The Viper just buys shares of the mutual fund and allows you to trade it every day. So they don't have to set up anything new. Pretty ingenious the way they did that. So Vanguard does. I don't think Vanguard's ETFs are as popular as iShares and Spiders, but they're certainly out there. And State Street, you're probably not aware of State Street. State Street's kind of a quiet bank because it doesn't do a lot of investment banking kind of stuff. They're a big custodial bank, which means they just help firms do the accounting for their investing, but they're a big index shop, and they do manage money. State Street has some impressive investment. So don't forget about them. You know, the big downside of State Street is that they're in Boston. And so it's kind of a cold place to live, but it's not a bad place. I don't think we've ever had a UTSA student get a job at State Street, as far as I know. So you could open the doors there. Right, so that's ETFs. I'm going to talk a little bit more about that. All right, 401k plans. Y'all all know this, right? Someone discovered this in the early 80s in the tax code and said, hey, wow, we can make some money off of this. No one really knows this is here. This is pretty major. And suddenly it took over the world. And it took over the world at just the right time, right when the stock market was taking off. So you had this people discovering this new way to get money invested in a tax efficient way. So it's essentially, it's a mutual fund, it's an exchange traded fund, it's a separate account. It can be all those things, but it's for employees in a particular company. So at USAA, most of our 401k at USAA, where it's investing in mutual funds, are commingled accounts, taking our employees' money and putting them in there. So often the employer will match your contribution. I think when I left USAA, it was up to 8%, which is, you know, pretty good little raise to get just a match. You get it with before tax dollars. So that means you're buying in these shares. You don't, if you buy that 401k, you don't have to pay tax on that. It stays in there tax free until when? Till you start taking it out. So then it's taxable when you take it out. How much of it is taxable? Well, how much did you pay in tax? Zero. So every dollar that comes out is taxable. So you got to remember that. You might say, wow, I got $500,000 in 401k. Yeah, but Uncle Sam owns 20% of that. So you're going to pay tax as it comes out. Some firms have Roth 401k. So what do you do there? There you invest with after-tax dollars. It grows tax deferred, but when you take it out, it's, well, supposedly tax-free. I actually don't believe that. So I'm actually in the camp. Y'all can see, find me in a nursing home in 30 years, but I actually think Roth IRAs, with the deficit the US government has, I really think it's a good chance Congress is going to make them taxable and just change the rules. And that seems unfair, right? We're talking in my life insurance class, right, Avi, about how the whole world's set against you guys. Everything's going to old people and young people are paying the brunt. So we'll see. But that's a 401k. Should you be in your plan, your company's 401k plan? Well, if they match, you should certainly get the match. But if your firm bundles their 401k, I'm going to argue they're ripping you off big time. I hate bundling. I had this battle at USAA. What is bundling? So let me explain it to you, and you can see if your employer is doing this. But bundling is, your employer provides you this plan and they've got to pay for the record keeping. So they have some costs, a few $100,000 in costs, and they pay for that. And you say, okay, well, that's just the cost of doing business. And then someone comes along like Fidelity and says, you know what? Give us your 401k plan and we'll give you that record keeping for free. We'll save you $300,000. And the company goes, wow, that's great. We'll do that. Now, why would Fidelity give record keeping for free? Because now they're getting all this money from the employees, and what are they doing? They're sticking it to a 401k plan that's overcharging the employees for that mutual fund. And so what Fidelity does is they give the company $300,000 of free record keeping, and then they overcharge the employees $500,000-$600,000. So that sounds like a good deal, doesn't it? We saw, there was a guy who came from another company to USA, and he's like, you guys are idiots for not bundling. I said, okay, well, prove it to me. And we went through a whole math with him. After the fact, he was kind of like, well, I kind of did a horrible thing to my employees at my previous company. So yeah, you did. You really ripped them off. But you can show two mutual funds. One's their normal mutual fund, one's in the 401k plan. You can see how much more they charge. for that. It's a ripoff. I think it should be illegal because ours is responsible for USA's 401k plan, and ERISA says I can only make decisions for that plan that are in the best interest of the participants. How does shifting $300,000 in record keeping and making it $500,000 expensive for employees in the best interest of the plan participants? I could never make that argument. I thought it should be illegal. And there have been people out there who have talked about making bundling illegal, but so far, and I liked one firm. They were talking about going from bundling and going back to the old way in order to save money for all their employees. And one of the banks, there's a wonderful video. I think it's a Frontline video. And he said, no, that's not good for the employees. And they said, well, why not? Their fees go from 50 basis points to 30 basis points. And he says, well, employees don't like change. Change is bad. People get nervous. And it's like, yeah, they're not going to notice it other than their fees come down. That just doesn't make sense. So more of our industry ripping people off. All right. So do y'all have a 401k? Anyone in here? Does it bundle? No. You don't think so? It's hard to tell. If it's a smaller plan, it probably does, because a small plan just can't afford the record keeping. So you're almost stuck with it. It was interesting to me. We did a request for proposal because this guy said, we're going to do bundling. I said, that's fine. I'm just going to add this question about what's in it for the employees. And when we sent that request for proposal out, Vanguard got it. And they said, we're withdrawing from this request. They said they kind of got my game. And they didn't want in writing to have to say, how are we going to make up something that says this is in the best interest of employees? There's no way we can do it. So they just withdrew. The other firms, they held this glowing language about how it's in the best interest of employees. I was like, yeah, okay, whatever. Y'all can tell I'm somewhat cynical about our industry. So active versus passive, we already talked about that. Active, you're trying to beat the markets, so your fees are going to be higher, but you're hoping to get higher returns. You're trying to find managers that are going to beat the market. How do you do that? Who knows? Good luck with that. What do most people do? They buy past performance. Wow, they've done really well the last 3 years, so let's put money into them, and that doesn't work. We know that doesn't work. There really is no way to know how to do this. We use a consulting firm for some of our funds. And one of the questions I put on that request was, tell me, once you recommend a fund manager, how they perform going forward. And boy, they hated that question. And the answer was, they perform about as well as if you threw darts at a dartboard. That was the answer. So you're hiring us to essentially do what you could do for free with the dartboard, and we're going to charge you $300,000 to do it. And why do people, we know that, why do boards do that? What are the boards doing that for? Are they doing it to get better return and help their employees? No, what's the board trying to prevent? They don't want to be what? They want to be sued, right? We went through this process, we hired this company, everybody does this, we did what everybody else does. If they ask them on the stand, well, do you know if this works or not? That would be kind of a tricky question. That was always in the back of my mind. Well, if the employees sue me, which they can do, right? I'm a fiduciary to the plan. The employees sue me and I go on court and they ask me, do you believe this is in the best interest of the employees? And I would have to say, well, no, the data is overwhelming that this doesn't work, but we did it anyway. That doesn't sound good for me being sued by my employee. So I was always fighting hard. There was one board meeting where the head of HR was going to switch to bundling and do all this stuff. And I kept fighting him. And she got so mad at me. She said, we're going to take this to the vote so we can shut Ron up. So I was ready to fall on my sword. I was ready to go for it. So she brings it up. And then president of the investment company says, why would we ever do that? I was like, I don't want to fall on my sword today. But so I had two people, actually, the president of the bank and the investment company, both shut that thing down. I was so happy. All right. So passive, that's when you buy the market. How is that done historically? It wins about 90% of the time. So if you want a 90% chance of winning, go passive. If you want a 10% chance of winning, go active. Most retail investors should do what? Should go passive. What does Warren Buffett say most retail investors should do? Warren Buffett, what do you think he says? Invest for the long term, but does he say active or passive? He's a very active manager, right? That's his whole thing. What does he say retail investors should do? Passive, right? Charlie Ellis, Jack Bogle, some of the biggest names in finance say go passive. Most investors should go passive. Why? Is because there's no one out there beating the market? No, there's plenty of people beating the market. The question is, can a retail investor find those people? They can certainly find the people who beat the market historically. That's easy. But that's not what your job is. You want to find the one that's going to beat the market going forward. And how good are we at that? We're horrible at that. And by we, I'm not talking retail investors. I'm talking about professionals who do nothing but this. They have CFAs, master's degrees. They're horrible at it. They're no better than throwing darts at a dartboard. So you might say, well, I'll just go out and buy Morningstar five-star funds. How do they do? Statistically, no better than 2-star funds. So a 5-star fund is no more likely to outperform than a 2-star fund. So that's the facts. And if you don't believe it, go read. This is a big part of our industry's research. I've heard of Charles Ellis. I don't know how to spell his last name. That might be he. Hopefully it's not that one. Charles Ellis, stocks, passive. Is he going to come up here? Hey, I got it right. So there he is. He's a great speaker, a great writer again. So here's another one to go YouTube and listen to. I think he's still around. I don't think he's passed away. He's been around for a long time, so it just seems like it. So he's getting up there, right? He looks my age or so, but Winning the Loser's Game, you probably have heard some of these books. So he's very, very famous. The industry hates him because he just keeps pointing out, you guys are charging all these fees and you have nothing to show for it. Your customers are no better off. In fact, they're worse off because you're charging all these fees, and yet you're telling them you're charging the fees so that you can get them more return, and you fail miserably at this. So there are people out there like that are talking about our industry and honestly, exploring the actual what research says. Now, Vanguard started the index funds in the 70s, and when they did that, Fidelity came out with commercials and said it's un-American because they say if you buy the index, you're just gonna get the average return of the index. And why would Americans want average? We shouldn't seek for mediocrity. Guess what Fidelity was doing a few years later? They were selling index funds because they got so popular and they did so well. But the math was overwhelming that mediocrity outperforms 90% of the time. That's pretty good, right? Mediocre wins 90% of the time. That would be nice. All right. I can't remember where I talked about ETFs. I have them in here somewhere. Let's talk ETFs just a second here. I might have taken that out of my notes here. It may be in the, they're still in the class notes somewhere. Right, so the Spider, 387 billion. The iShare, 291 billion, that's the S&P 500. There's the Vanguard, 266 billion. So those are the three largest ones. Well, it looks like Vanguard's even doing better, right? So maybe I was wrong about Vanguard. They've got two there, 266, 251. The largest ETFs, we just saw them. But the advantage of ETFs being large is this isn't economies of scale game. We used the Barclay funds back before when they had iShares, and they were charging us 1 basis point. 1 BIP. So 1 basis, I mean, that's almost nothing. We had like $1 billion with them at 1 basis point. I remember they flew from the UK to visit us, and I'm thinking, I don't think we paid you enough just for this trip. Why are you visiting us? The S&P was up 10%, you're up 10%. What are we talking about? You know, it's like, what a waste of time and money for you to come over here. So, so yeah, there's some big ones out there, but there's some really, really interesting ones. So major, I'm going to do leveraged ETF. So what is a leveraged ETF? Have y'all heard of that before? So we've gotten kind of crazy in this industry. So a 2 times leveraged ETF, if the S&P is up 10%, it's going to be up 20%. And if the S&P is down 10%, it's going to be down 20%. All right, that's a leveraged. What about an inverse? So this firm right here, I can't say its name, Direction, their website. Let's see if we can get to their website. I can never spell their name. That's why I have to look it up. Do I have to answer this? There it is. Okay. So here's their ETFs. So they have levered. They also have inverse. What do you think inverse ETFs are? Yeah, it's going the exact opposite direction. I have an inverse ETF on the bond market. Why am I doing that? I'm shortening the duration of my bond portfolio, right? So it's on long treasuries. So if interest rates fall, what are long treasuries going to do? They're going to go up. What's my inverse ETF going to do? It's going to fall. What if interest rates rise? Treasuries will fall. My ETF will go up. All right. So you have leverage and inverse. So 1 time, 2 times, 3 times. Can you imagine a 3-time levered? The S&P is up 10%. You're up 30%. How good of a job did they do? It's really interesting. Go back and see if they actually get the numbers they're proposing that they're going to get. So you could actually look at that and see. And then you have the inverse. So daily consumer discretionary bull 3 times. So not only is it levered, but it's levered on an industry. That's amazing, isn't it? Home builders and suppliers bull 3 times, and look at that ticker. That's pretty cool, isn't it? Their ticker's NIL. So I don't know. I don't know anyone that works for this firm. It'd be pretty cool to work for this firm. They're a pretty wild group. I just imagine they're all a bunch of surfers or something. It's a pretty crazy firm. Probably a bunch of mathematicians in there because it's not easy to produce a 3 times return. It really is pretty tough. I don't see their inverse ones. So it doesn't tell me how to get, boy, this is gonna break a crick in my neck. But anyway, so there's pretty crazy stuff. You have any idea this is going on? This is major. They also have a VIX. They have VIX funds. Y'all know what the VIX is? The volatility index. So it's the implied volatility in the S&P 500. We're going to talk about it later when we talk about options. You can actually buy the VIX. When does the VIX go up? When everybody's worried about risk, stock markets are crashing. So if you buy a VIX fund, so back in 2008, the VIX jumped from like 20 to 80 really fast. So if you bought the VIX, you would have something going up quite dramatically. The problem is, if you look at VIX funds, it's really interesting. If you graph VIX funds against the VIX, they don't do a very good job. People are really disappointed. You see the VIX up 40%. You say, wow, I just made 40%. They go look at their VIX ETF and it's up 17%. It's like, okay, what happened? That's pretty upsetting, isn't it? And it's because you can't really buy the VIX. It doesn't exist anywhere. You better have a couple of PhDs in math. You're going to create a VIX fund because it doesn't exist anywhere. There's no such thing as a VIX. It's an implied number in the option market. How do you buy that? So you have to somehow set up your option trades to somehow replicate that. So anyway, pretty incredible stuff. All right, I don't know where I am here. All right, so that's active versus passive and how the ETF market helps with that. All right, so one thing that we can definitely talk about on passive is this concept of market efficiency. We're supposed to spend weeks on this, and I don't think it's all that interesting of a topic, but I do think it's important that you have to know it because it is very, very central to finance. So are markets efficient? And there's two ways to think about that. There's informational efficiency and fundamental efficiency. Information efficiency is how quickly do markets incorporate new information? And what's your guess on that? A little bit under a second, right? Pretty dramatically. So that we know markets react really quickly to new information. The second one is fundamental efficiency is, does the market have biases where they get something wrong? They get good news and they underreact, they get bad news and they overreact, those kind of things. All right, and that underreaction is actually something that hedge funds have discovered. When firms report good news, the stock price goes up, but not enough. When they report bad news, the stock price falls, but not enough. And there's hedge funds that just bet on that. They buy firms with good news, they short firms with bad news because they think over the next 3 months, those things are gonna, spread out even more. That's kind of disappeared because hedge funds have really taken advantage of it. But the fundamental efficiency, how good are markets, not just at reacting to new information, but actually reacting correctly. And by correctly, what it means is if there are errors, they're random. So people who overreact are offset with people who underreact, and there's no bias in the numbers. All right, so we're pretty smart people. We don't tend to make mistakes all in the same direction. And so good old Fama came along and he tested this market efficiency, and he did it in 3 ways. The first test he did is called the weak form test. And he just want to ask, if the only information you had on the stock was its historical stock price, could you beat the market? And that's called technical analysis. If you've heard of technical analysis and charting, we have in a society class on Monday. Jabari's teaching it on technical analysis. And he's really getting into it. We had a pretty big debate 2 weeks ago. It's like, all right, Jabari, tell me exactly what you're gonna, he's showing this fast. Are you really gonna sell there? He's got this chart. He says, see, I would have sold right there and see all the money I would have saved. I'm going, okay, wait a minute. Would you really have sold there? Because look, 2 weeks earlier, you had that same pattern and you weren't selling there and it kept going up. And it's like, that's the thing on technical analysis. It's like when they show historical charts, they sound so smart, but what would you have really done there? And what Fama found was he didn't think you could really beat the market by looking at past prices. One of the things he did I thought was pretty telling is he created some stock charts, just pure random. So they were really just random numbers. And he took actual stock charts and random ones and showed them to technical analysts, and they couldn't tell the difference. So if they're actually seeing something, shouldn't they be able to tell the difference between a random chart and an actual chart? But they couldn't tell the difference. Now, what does academia say about technical analysis? Does it work or not? They say it doesn't work, but I don't think the answer is in on that. There's another famous person. I'm giving y'all too much stuff to read. Dr. Lowe, another person I really, really like. He wrote this book. So Dr. Lowe, you should go. He has a lot of YouTube. In fact, his entire MBA class, corporate finance class at MIT is online. You can watch it for free. Really nice man. In fact, we had one of our presidents of Investment Society. He was graduating and leaving. So I bought not this book, but his other book. And I emailed him and go, Dr. Lowe, would you autograph this book for me? He said, yeah, sure, send it along. So I sent it up. He autographed it, put a really nice, well, he wrote a really nice comment, but he wrote what I told him to write. So, but anyway, it was a nice comment. But anyway, this book I do recommend. He doesn't tell you how to do technical analysis. That's not the purpose of this book. The purpose is to ask, does it actually work? Is there something there? And he argues that it does. And he's a really, really smart person to listen to. So he argues that it does. He goes back really, really far, back to ancient Rome. Technical analysis back then of people racing on their horses to get to the next city so they can say, hey, buy your wheat today because the price is about to go up, kind of thing. So he makes the case for us. So why would you read this book? I would read this book before you start learning how to do technical analysis, because you need to have some basis for why you believe it works. If you can't explain why you think it works, then why are you doing it? And then after you do that, you can then go get another book. By a UTSA professor. I don't know if that's it or not. I can't tell. That doesn't look like it. Might be this one. I can't read names. But anyway, Dr. Dahlquist, she taught here for many, many years. She wrote a book on technical analysis, and it's that thick. I mean, it's a massive book. She also spent some time explaining technical analysis. In fact, of her book, I couldn't get through the whole thing. I don't like technical analysis. I find it a little tedious. But the first few chapters, she also makes the case for technical analysis. And I think she does a good job on that as well. When she was here, she actually was the last one to teach our technical analysis class. We had one, and she was the last one to teach it. It wasn't offered every semester. I begged her to teach it again, and they did it for a semester, and I wish I could have sat in on it. So, you know, it's kind of cool. We had a professor here at UTSA, but I don't know which of the books. I don't see her name on any of those books. She wrote it with somebody else, so there's two names there. So that's another book. The first few chapters are really good, and then the rest of the book, I don't know how far I made through it, but she'll say, here's a technical analysis. This is how it works. This is its historical performance. It's worked really, really well, but recently it stopped working. Next chapter, exact same thing. It's worked really, really well in the long term. Recently, it stopped working. Recently, it stopped working. Chapter after chapter after chapter. So, you know, it's kind of interesting. If you really want to get in technical analysis, the Bloomberg machines, they have a technical analysis function, and it's really, really good. They go through, they have a long, long list of them. You can click on one, click on a stock, and it will tell you exactly what the stock's doing, how to interpret the technical analysis, how well does it work. You know, if you want to do Fibonacci, or you want to do some of the volatility ones, which I kind of like some of the volatility ones. All right, so Fama says it doesn't work. Academia says it doesn't work, but there's some pretty good heavyweights out there that say there's something there. I think it does work, but you have to have the theory. All right, so I would say if you're going to be a technical analyst, you need to theoretically say, why does it exist? All right, and what technical analysts say is, on the second thing, on the semi-strong test, when it comes to fundamental analysis, they say fundamental analysis doesn't work because Wall Street is just too good at what they do. Technical analysis works because you assume stocks are all the information is embedded, everything's there. The only unknown is the supply and the demand. And technical analysis works because of the supply-demand imbalance, and those things work themselves out in predictable ways over time. So they actually believe that markets are very efficient, but that investors don't show up at the same time at all the same, you know, immediately. And there's these frictions in the system. So his second test is a semi-strong test, and there he's asking, if you had past prices and all public information, could you beat the market? Are there people out there beating the market? Does fundamental analysis work? His argument there was no. That's a little bit hard to test, but given that active managers underperform indexes 90% of the time, you know, maybe that's part of his argument. But that's a little bit hard to test. But is he saying there's no one out there with a good model that can consistently beat markets? You know, he probably wouldn't say that. But now, where is Palma working right now? He's working for a firm that tries to beat the market, but he won't say it that way. So you should read up on him. And it was kind of interesting. He's kind of anti-active management, and he's working for a firm that does active management. What is he trying to do? It's interesting. You should go read it. He's trying to say, well, we're beating the market, but we're not doing it by beating the market. We're doing it. So he's saying we're taking risk and we're getting paid for it. That's the way he'll always say it. So we're not finding a way to beat the market. We're finding a way to take a little bit more risk to get a little more return on a predictable way. It's like, okay, yeah, I'm not buying it. But anyway, that's his argument. The last one is a strong form test. And that if you had all information, including insider information, could you beat the market? And that one he can't really test. Because how do you know? You know, it's not like people are calling up, hey, Fama, I got some inside information. I just did a good trade. Yeah, no one's going to be doing that. And why wouldn't you do that? It's illegal, right? It's illegal. You can't trade on non-public information. If you're sitting on a plane and the CEO of Valero's talking to the CFO of Valero in front of you, you hear them say, wow, when this hits the market, this is really gonna, our stock's really gonna take off. And you hear that, can you run home and buy Valero stock? You can go to jail. And how are they gonna find you? And you say, well, Avi, you've never made those kind of trades before, and you're on the plane with the CEO, and suddenly you come home and buy 2 million shares. You mortgage your house. Yeah, something's going on. Maybe Avi doesn't do it, but Avi's uncle does it. Now they're like, okay, your nephew is on a plane. That's what the SEC is going to do, and they will find you. So there's no way to get around this. What if they talk about information and it's public, but it's immaterial? Can you trade on that? That you can do. Right? Who decides if it's immaterial or material? The court, huh? The court decides. So Martha Stewart went to jail. If I remember the case correctly, it was an insider trading, but I think the court decided it was immaterial information, so she didn't violate insider trading. What she violated was, I think she lied on the stand or something like that. But anyway, you might look up. So look that up, huh?
That was tax too.
I don't remember the tax piece, but you might look it up. That's the last I remember, but I can't remember all of that. What if you could find 1 million pieces of immaterial, non-public information that combined is material? Could you trade on that? That you can trade on, right? So yeah, it's kind of strange, the rules. If you take the CFA exam, this is a big part of the ethics of the CFA exam, is non-public information. So you gotta know that piece. That you can't test. The way you try to test this, and this has been interesting, is most CFOs, when they trade stocks at their own company, they're not going to do it if it's going to cause them this huge tax loss of some kind. And so what FAMA did is goes, okay, let me go see when a CFO trades something that doesn't make sense from a tax standpoint, because that must mean he or she's trading on insider information. And let me see if that trade actually makes sense. All right. So this CFO normally sells 10,000 shares every year, and suddenly they traded 80,000 shares. So they must know something inside and see that. But that's a tough way to really test it. All right. Some people have questioned Congress about insider information because they're hearing all these reports from the Fed. And that sounds pretty bad, right? They're getting this report from the Fed and they go out and they trade. That should be illegal. And people have talked about that. The only problem with that is the studies have shown, even with all the information, they're still horrible traders. So it hasn't benefited them any. But I mean, it kind of makes sense, right? Because you're in Congress and you're hearing the Fed chair say something, you shouldn't be able to run out and trade on that if the public doesn't know about it. But all right. So if we're going to do all this passive investing, what about the social purpose of investing? Don't we want active managers going out there and saying, you're a bad manager, your stock should fall, you need to be replaced as manager, you should be taken over, you should go out of business? Isn't that what we want the stock market to do? It's called allocative efficiency, that you want the stock market deciding who the winners and losers are based on how these firms are doing. If you have all passive managers, don't we lose that as a society and we don't have anyone watching? Well, maybe so, and that's been a debate, but so far, passive is only about 25–30% of the market. So we still got a lot of people watching. And BlackRock, I think, is becoming somewhat of the model on this. What BlackRock says is we do passive investing and we do active, and we have a lot of active investors. So we're voting shares on our stock. So what we're going to do is our passive investors and passive funds, they can't vote shares because they don't have time to research all of that. They're passive, right? They don't have many people working for them. But we do have active managers and they're voting the shares. So what we're going to do is let the active managers go and vote the shares for our passive managers. So you get that allocative efficiency because BlackRock's still voting all of their shares. They're just not wasting the time of the passive managers. So that makes sense. I had to vote shares at USAA, and I can tell you, institutional investors just don't spend much time on it at all. So it is somewhat of an issue. We had a guy named Michael, and his job was, we actually use an outside firm to vote our shares. And then Michael's job was to bring me any votes that we thought we didn't want them voting, we wanted to vote them. And he came to me maybe once a month with a vote. I get calls from other investors trying to get us to vote our shares in a certain way. And I would say, yeah, whatever. But what do institutional investors do? If they don't like a company, what do? They sell the stock and they go somewhere else, right? They're not going to try to fix the company. They don't have time to do that. So who does try to fix the company? What do you call those type of investors? Activist investors, right? So there are those people out there. And so, but most investors today are institutional investors, and they just don't care. It's like, if this is a poorly run company, we'll just sell the shares, we'll go somewhere else. We're not going to vote and try to get new management and all that kind of stuff. Warren Buffett, he says investing is like batting without strikes being called. What would the Major League Baseball be if they didn't call strikes? Be a pretty long game, wouldn't it? And you would have a lot of dead pitchers. I agree with that. But what I discovered when I went into this is that's true, except institutional investors are paid to swing. We're not paid to hit, we're paid to swing. And so when you're paid to swing, guess what you do? You swing all the time. Right? My boss was like that every week. Hey, Ron, what are you going to do? The Fed just announced something. What are you going to do today? What are you going to do tomorrow? It's like, give me a break. We're not doing anything. It's new information, but I mean, it's not like, but he thought we were supposed to be out there doing all these trades every single day. All right. So one thing you definitely need to know is all of your major indices. So if you're going into an investment job, you want to make sure you know what the indices are. So you know the S&P 500. Let's use exam 1 definitions. The S&P 500 is an example of what? Intermediate term bonds, high yield bonds, international stocks, real estate. What is S&P 500? Large cap, was it growth or value or both? S&P 500, we call it core. You are right, it's a little growthy, but it's really core. What does core mean? It's somewhat balanced between growth and value. All right, so if you see core, it means that's related. Core is related to value versus growth. So core means it's really neither, but there is and large cap value, large cap growth. So you would see those there. The S&P 500 is market cap weighted. So bigger companies have bigger weights. They're just weighted based on the market cap of the firm. The Dow Jones, I hate the Dow Jones. I don't like it. People like it just because it's been around so long, but it's a price weighted index, which is just really bizarre to me. That a stock that trades for 50 bucks is going to have half as much weight as a stock that trades for 100 bucks. What would happen to a stock that trades for 100 bucks if they do a 2-for-1 stock split? It's not going to be a $50 stock, right? I mean, it has no economic meaning to it, but that's how the Dow weights their index. It's just a bizarre thing, which means every time stocks split, the Dow has to rework their formula to adjust for the split, which means right now the Dow is probably just a complete mess. What is interesting on the Dow is when they kick a company out and they bring a new company in. So that's pretty interesting. They kicked out what? GE, and they brought in, I forget whom. There's been some interesting, there is a very interesting study of, what company has been in the Dow its entire history. And that would be, you can go look at that. I think Exxon's the one that finally got kicked out, but you have to go back to Standard Oil and all that. So anyway, all right, the Russell 2000 is what? I even leave it up there for you. So small cap, is it growth or value? It's core. Russell 2000 is a core. So Frank Russell up on the West Coast. They created Russell 2000. Why does he get the Russell 2000? Why doesn't the S&P get to define small cap? It's movers advantage, first movers advantage. They're the first ones to come up with this concept of small cap and create an index, and so Russell 2000 is considered to be the small cap. There is a Russell 1000. The Russell 1000 is Russell's large cap. The Russell 2000 small cap. And most people use the S&P 500 for large cap and the Russell 2000 for small cap. Mid cap, S&P does have a mid cap. They do have a small cap. Their mid cap's the S&P 400. Their small cap is the S&P 600. But the main ones you want to know are the S&P 500, Russell 2000, S&P 400. And then developed markets, we use MSCI. MSCI used to be Morgan Stanley, but Morgan Stanley sold MSCI, so it's no longer MSCI, Morgan Stanley Capital Indices. It's just Morgan Stanley now. I mean, MSCI. MSCI has U.S. large cap, U.S. small cap, has all of that, but they're most famous for developed markets. So the MSCI EFA, and I never remember what EFA is. Europe, Asia, Europe, Australia, Far East, I think is what it is, which means it's missing Canada, which is a problem. So you have to know, if you want developed markets, you have to get the EFA and you have to go buy Canada's separately. Emerging markets, that's also MSCI. MSCI is just famous for non-US. That's just their thing. But S&P has a non-US stock indices. I don't know if Frank Russell does. So the MSCI Emerging Market Index. On the bond side, it used to be Lehman Aggregates. Why don't we use Lehman anymore? They went out of business, right? So Barclays bought it, so now it's the Barclays Aggregate. The CEO of Barclays brags that it was an incredibly good buy to buy Lehman. Some people have sued him for buying Lehman for too cheap. But why did he buy Lehman so fast? Well, Lehman was the big bond king. And if you waited too long, what's going to happen to all of Lehman's great employees? They're going to go somewhere else. So he needed to buy that fast. He was just capturing those employees. And Barclays is not known for fixed income. That was a way for Barclays to suddenly become a major fixed income company. So the Barclays Ag, I had a professor just this week talk about the Lehman Ag. It's like there's people still, this is a habit. It's hard to break the habit of saying Lehman Ag. There's a second famous bond indice, and it's called the Merrill Lynch Ag. So don't put your name on a bond indice, or else you're going to go out of business, because both of those big bond kings both went under in 2008. Merrill Lynch got bought out, but since they went under. We already talked about we've already talked about these, the equal weighted, market weighted, fundamentally weighted. Those are the three most common approaches. Equal weight also performs extremely well. But what is equal weight going to give you? It's also going to give you a strong value tilt. Y'all see that if you do equal weight? Because water value stocks, they're cheap stocks, which means their market caps are small relative to the companies. So if you do equal weight, what are you doing? You're essentially buying more of those cheaper companies and buying fewer of the expensive companies. So equal weight, fundamental weight is essentially a cheap way to get a value index. And they work extremely well. They don't just have higher returns, but historically they give you higher returns with lower risk. That's supposed to be impossible in finance, but they do that. Now, the last few years have really harmed that because of these massive tech companies in the US. That has really hurt those. I did give you the methodologies for S&P and Moody and MSCI. I'd read those. I definitely would read the standard, this S&P one. It's really quite interesting, and it's short. The MSCI one is like 100 and something pages. The S&P is only like about 7 or 8 pages. So if you really want to understand these indices, how they're built, they have that out there. The MSCI is pretty interesting, but it's a lot of pages, but it's interesting to understand what's going on with these indices. It's not a simple thing. These are really quite complicated. MSCI EFA went from, I think, like 8,000 stocks to 20-something thousand stocks just overnight. They decided to really broaden their indice. So there's a lot of stuff going on here that has a lot of implications, because once you become the index, everybody's graded off of you. And boy, that's huge. What happens to a stock when it gets kicked out of the S&P 500? Its stock price just dives. When you get kicked into the S&P 500, your stock price goes up. I mean, it makes a big difference. There was on the bond indices, when GM got downgraded from investment grade to below investment grade, it was a huge problem for the bond indices. So GM was massive in the Lehman aggregate, but it was much more massive when it moved into the high yield indices, because suddenly GM was like the biggest investment in the high yield bond indices. And it was like I don't know, 10%, 15% of the indices. So suddenly you have this industry that didn't have GM, and now it has GM, and GM's the biggest piece, and it's like 15%. So if you're a high yield bond manager, you don't own GM, guess what you're doing? You're making a massive short bet on GM. So what do you do if you don't want to do that? You got to go out and buy GM debt. How do you do that? That's not very easy to do. You got to go find all the people that have GM debt and try to buy their debt. So just that one act of GM going from investment grade to below investment grade messed up all these indices just overnight. So this aggregate bond index here is only investment grade. The last time I looked, it was like 70% treasuries and mortgage backs. So if you buy the Barclays aggregate, you're betting on treasuries and mortgage backs. So people who are graded against the aggregate, they tend to just buy corporates. So they're not even really comparable. So I think if you got a corporate bond index, should you go against the Barclays Ag? No, you should go against a corporate bond index. You shouldn't go against that. All you're doing is just betting against treasuries and mortgage backs. So there's a lot of stuff going on here. There's an entire book you can read on this, on what makes a good index. Is it investable? Is it known in advance? There's several things you have to look at. And all of that's on the CFA exam. All right, so I'm going to actually just skip this part. So if you want to know about shorting securities, I'll let you do that on your own. You can read the class notes. It's pretty straightforward. You want to know about buying on margin, you can do that on your own. These are just ways. The shorting securities, a way to bet that a stock's price is going to fall. Margin is just a way to leverage up. You know, that 2x, 3x, you can kind of do it yourself by just borrowing money. Put 50% down, you'll 2x your portfolio. So I'm not going to talk on that. I will maybe on next class on shorting securities. I might talk about the securities lending market a little bit, just to make sure you have some exposure to that. All right, we'll start there. Next class is the exam for the first 30 minutes. All right, thanks.